Thank you very much, Peter. So my name's Lachlan Campbell, and I'm a portfolio manager here at Duxton Capital. And today I'm here to speak about Duxton Water, ASX D2O. So we started Duxton Water 6 years ago now, and it's the only ASX-listed water investment vehicle. And when we've grown the asset base from $60 million out to about $390 million in that same time period. So water as an asset class, it's still something that's quite niche and it's not very well understood, but the investment proposition behind water is actually quite straightforward. So at a very, very high level, it's a defensive and alternative asset class. It pays a very reliable and stable dividend. It acts as a great inflation hedge because of the real asset nature that sits behind it. It's got low correlation to basically every other asset class out there. So it's got a really nice diversification piece when it comes to considering an investment portfolio. And all of this is backed by some really strong long-term demand and supply drivers, which I'll touch on shortly. So before I get into who Duxton Water is and what we actually do, I think it's really important for me just to explain why we actually have water markets in the first place, because again, it's not something that's commonly understood. So really quickly, the government created water markets in the early 80s. They did this by what we know as unbundling land from water, and they did that by introducing what's called a cap and trade system. So the reason why they did that is because there was a drought that popped up in the early 80s. And essentially the government realized that they'd over-allocated water licenses that were owned by farmers. They over-allocated, 50 or 60 or 70 years ago, back in the early 1900s, when they first issued water licenses. Now, the government needed to come up with a way to take back these water licenses because they needed to hold on to them for the environment because the river systems were dying. And they needed to do that in a way which didn't cause, didn't take away from regional communities. Because if you take away 30 or 40% of water that's on issue, you're taking away 30 to 40% of people's livelihoods. So what they did is they introduced water markets. And by doing that, what they actually did was the goal of water markets was to improve the marginal return of every megalitre of water used. And essentially that's been the focus of, the last 20 or 30 years. And ultimately the idea is that by improving the economic output of regional communities, the government can then actually recover water licenses back from farmers for the environment without actually causing this dip in economic output. And that's ultimately, the reason why we have water markets today. Exactly. In terms of the area that we operate in, so we predominantly invested primarily in the southern Murray-Darling Basin. Now, it's an area that covers southern New South Wales, northern Victoria, as well as part of South Australia. Now, water licenses on issue in this area are about $30 billion as of, I think, June of this year. And then water license trade within this area is anywhere from sort of $1 to $2 billion per year in terms of market turnover. And again, like this area that we focus on is or does account for about 80% of Australia's water license trading activity. So, we've certainly just chose to focus in this area because it's what's known as the food bowl of Australia. And certainly, this is where a big part of Australia's economic output from agriculture is actually generated. And, in the 2021-22 financial year, it was estimated to be $85 billion or so of economic output coming out of this region. So the market in which we operate is quite big. In terms of water market development, this is a graph in front of you. You can see is what's called the AETHA Entitlement Index. It's put out by a company called AETHA, who is Australia's leading water market independent expert. And it tracks the value of a common basket of water entitlements since 2007. And what you can see is that water licenses have actually received a compound annual growth rate of 9% since 2007. But what's really interesting is if you look from 2016 onwards, which is when we started Duxton Water, we've actually seen quite a steepening of that curve. Now, that's primarily due to what we call as a shift to permanent horticulture. So what we've seen is people starting to plant crops which are high value commodities. So ultimately, this is that shift of people actually doing more or creating more economic output with the same megalitres of water. So in terms of what a permanent crop actually is, it's a crop type that is harvested from a plant or a tree that lasts for multiple seasons. So think of, we've got vineyards up on the screen in front of us. Think of a vineyard. Vines can be 10, 20, 30, 40, 50, 60, 100 years old, but they need water every single year. If you don't water your vines, if your vines don't get water, they die. Now, this is the same for a lot of other permanent horticultural commodities, such as, we're talking about vineyards, tree nuts, citrus, stone fruit, olives, almonds, etc. So, what we see is the more and more of these permanent crop types that are planted along the southern Murray-Darling Basin, what we're doing is we're increasing the long-term demand profile for water. Now, this demand profile for water is actually inelastic, because if these trees don't get water in any given year, they die. So what we're seeing is people convert their what we call annual cropping areas, so they might do cotton, cereals, pastures, etc., over to these permanent cropping areas, permanent crop types, which have quite a thirsty and inelastic demand, a long-term demand for water. And we think that's only going to continue one way. Okay, so now we've spoken a little bit about some of the macro behind water. I'm going to actually now step into the business model and introduce Duxton Water and explain to you the business model and what we're actually doing. So first of all, what is a water license? Well, a water license is a perpetual right to receive an amount of usable water from the defined resource in any given year. And vice versa, the usable water is the volume of water assigned to a water license holder every year. So the way to think about this is think of a bucket where the water license is the bucket that lasts forever. Now, because you own that bucket, the water regulators come in every year and they give you an amount of what we call physical water into that bucket every year. That's what we call usable water. And that's the physical component. What we do is we also refer to a water year, which is 1 July to 30 June. Now that follows the typical annual production cycle of irrigated agriculture. But if you've got your bucket and you've got your water, if you get to 30 June and you haven't used your water, you haven't stored it in a dam, you haven't sold it, or you haven't leased it, you actually lose that water if it's not carried forward. So you need to use it or you lose it. And then finally, we refer to a megalitre in the water world, which is being 1 million litres of water. What does it actually cost? To put a little bit more context to it here, so typically a water license will trade for between $7,000 and $9,000 per million litres or megalitre. Now that's for a higher reliability license. They're the most sought after, sort of the top tier licenses. And the pricing drivers that influence these licenses is this long-term inelastic demand profile for water, permanent crops, long-term demand, as well as there's some supply side drivers as well, which is the government, which is intending to recover water for the environment for environmental purposes. In terms of the usable water, that will typically trade for between $100 and $1,200 for that exact same, 1 megalitre of usable water. And now the pricing for usable water is largely determined by short-term weather conditions. So as it is now, we're heading into our third triple La Nina. It's extremely wet. We're trading more towards that $50 to $100 mark. If we go back 3 years ago, we were in the middle of a drought. We're trading at that $1,000 megalitre mark for that same unit of water. So that's to give a little bit of context of how volatile the usable water price can actually be. In terms of the business model, we acquire a diversified portfolio of water licenses. So the business model is very similar to a REIT or a real estate investment trust. We buy an asset, we lease them to farmers or they're our tenants, and then we sell whatever we haven't leased back into the market. So by having 70 to 80% of our portfolio leased, that provides us with visibility to our revenue stream. So we get really good visibility, and that usually goes out. We do leases typically for 3, 5, and 10 years. Then we use our sort of active management strategy on the unleased portfolio to sort of sell down our allocations throughout the year and deliver water through to our customers. In terms of return, so we target low double digits. We're targeting a 5 to 6% gross dividend, as well as 5 to 7% capital growth. And that dividend target's based on the target that we've already put out, targets that we've already put out to the market going out 2 years. So because we have such a stable revenue stream, we actually get good visibility to our dividends. And same with capital growth, that sits well under the 9% compound annual growth rate that we've seen since 2007. In terms of water leases, the benefit certainly to us is that we've got a visible and stable revenue stream. That's number one. And what that ultimately means that we can do is provide a long-term dividend guidance out to the market. And by doing so, by increasing our lease percentage, it reduces our exposure to that usable water price, which can be quite volatile, as I've already explained. So, for us, we want a large portion of our book locked into leases. And then on the flip side, what does a lease do for a farmer? Well, it frees up their balance sheet. So if a farmer can access a lease, it means that they don't need to own expensive water entitlements outright, which means, we commonly refer to this concept of promoting an efficient use of capital. So if a farmer doesn't need to own water outright, they can then invest their capital into their land and production assets, which they can typically generate a higher return from. So by proxy, we're actually helping to sort of promote that efficient use of capital for irrigated agriculture. And finally, a long-term water lease provides great visibility to a farmer in terms of water supply and cost. So, a 10-year lease can give a farmer visibility to water supply and cost for 10 years, which is a very, very valuable tool when you consider how volatile Australia's climate can actually be. Just really quickly, I won't speak about this too much, but everything we do is about minimising risk. We set the business up to be boring, to be predictable, and to be relatively low risk. So we've structured our portfolio in a way which means that we can still pay dividends to shareholders when it's wet. We can still pay dividends to shareholders when it's dry. We've set everything up in a way to just try to normalise returns as much as possible. But certainly portfolio diversification is important, but also lease diversification. So we don't want to lease 100% of our water out to one client. We want to spread risk across commodity, license type, size, location, etc. In terms of our dividend flow, so this is a really interesting graph. So if you look at the dark yellow candlesticks for a second, they are historical dividends. So we've paid 10 consecutive and increasing dividends since the end of 2017. The green candlestick represents a dividend that we just announced a couple of weeks ago. So that's a 3.3 cent dividend being paid at the 28th of October with a record date of the 14th of October and an ex-div date of the 13th of October. So there's still a number of weeks before which shareholders can still get into the register to actually take advantage of that dividend. But because we have such a great visibility to our income stream, we've actually given the market another 2 years of dividend guidance. So what you'll see is, we've got 15 consistent, stable, increasing dividends dating back to 2017, which again is not something that we've seen a lot of companies do, especially in recent memory. So just really quickly to wrap up then, there's an excellent macro backdrop to water at the moment. If you look around at global markets and financial markets and seeing what's happened in the last 6 to 12 months, it's been relatively unstable, but water's performed exceptionally well in the last 6 months. Our shareholders themselves have received a 13.5% return in the 6 months to June. And again, just ticking off the things that we've spoken about, it's got a reliable dividend yield. It's a great inflation hedge. It's got low correlation to everything else out there. And it's all backed by some really strong long-term demand and supply drivers. And finally, the business is really scalable. So thank you very much for your time, and I'll hand back to you, Peter, for questions.